what's important. We sometimes talk about this. What is the role of these mega events? I think they're super important. It's one of those things where you have a lighthouse event that once a year brings everybody to your city, to your community, and it's a platform where when you reach that scale, then all of a sudden the government thinks it's interesting. All of a sudden, ministers are showing up, to this, and that's important for you to actually be able to change things, right? All of a sudden,
Yep. In this episode, I sit down with Michael Bak, Head of Investor Relations at TechBBQ, founder of Nordic Investor Day and a key player in shaping the Nordic startup ecosystem. With over 15 years of building communities and fostering investor-startup relationships, Michael shares insider knowledge that every founder needs to hear. Hey, hi, Michael. Thanks for joining me on the podcast.
Yes, of course. Good to see you again. It's been a little while, a couple of months since Slush. So it was very cold, but now you're back, right? It's still cold here in Denmark, but it's getting better.
Yeah, I can imagine. It's February. When does it start tapering off?
Oh, I think it's in April if we're lucky.
April.
And then we have a couple of months of good weather, and then it starts again. But I mean, you don't live here for the great weather, right? So yeah.
Yeah. No, but I've been there in, I think, end of May, June is when I was there at Copenhagen.
Yeah. Sun is the best marketing tool for any city, I tell you. That's always how it is. Definitely the right time.
Yeah. Well, not June in where I am.
Okay.
That's 49 degrees Celsius. You don't want this. You don't want the sun.
That's fair enough.
But yeah, Copenhagen in June is amazing. Well, yeah, it's been a minute. We met at an investor event since I started a little bit of investing. I thought let's go to some investor events as well, and that's where. Do you want to talk a little bit about your background and what you do for TechBBQ and your association with TechBBQ?
Yeah, sure, I can do that. I mean, I've been in this ecosystem for quite a while in Scandinavia. I think it's, I mean, always when I was studying and stuff like that, I used to start student organizations and small things like that, small companies. So I think I made the first start of a company, I don't know, a little over 20 years ago. And then, but I really kickstarted, I think, the ecosystem work and working with like more organized with the community and ecosystem work when I moved to Copenhagen, and that happened in 2007, 2008, that time period. And then ever since then, I've kind of did this thing where I work with helping others start their company or facilitating networks, building ecosystems, and then once in a while had a company of my own as well. So it's been a little bit in between. So I've had 3 or 4 companies, however you count it, and it's been such a good experience as well. None of them have made it really big, but you definitely learn a lot. But then I've been in the ecosystem for so many years that I've seen a lot of stuff from that side. I think it's important that you tried both. Tried fundraising, tried selling, and made sure that you have all those experiences when you also try to bring people together and make sure that value comes out of it, because that really is what the community work and the ecosystem is all about, right? It's trying to put the right people together and build the foundation for future growth for a lot of companies.
Yeah. And so you've been building communities for how long?
I would say it's over 15 years at least. I think out of the ones I can mention, I mean, I used to be part of running the big university program here in Denmark called Venture Cup. It was started by McKinsey back in the days. I used to run this organization. It was across all the universities in Denmark. We were building like a light version of an accelerator program through a business plan competition as well. So a very interesting concept, trying to bridge the gap, of course, for students to become entrepreneurs. Back in the days when I started there, I think it was 2006 or 7. Nobody really wanted to become an entrepreneur in this part of the world, right? Everybody wanted to join a big company. And to be fair, I mean, we definitely saw the switch in what students were interested in, and how that changed with first and foremost actually the development of the introduction of the iPhone, and subsequently
Yep.
of course the App Store. So the App Store was really what changed everything. Everybody started to we found out that distribution was super easy. It was much easier to build something and make money off it online. Of course, you had that before, but it was a bit more tricky. Now it became easy for anybody more or less, and that was really actually what kind of kickstarted it. I would say, at least in Europe, and at least in Northern Europe, how to really everybody wanted to start a company. And today, I mean, most people have, almost all students, at least at business universities and stuff, have had some sort of company or worked at a startup or something like that along there. So that kind of switched. So I was running that for a few years as well across the universities. I've been running a big co-working space, the biggest at its time in Denmark as well. At one point, and I think that's part of the Copenhagen story. Actually, I was part of a group of people who initiated a grassroots organization, you could say. I think it was the first of its kind in Europe, at least, that were completely initiated by, started by, funded by, and developed by startups themselves. So that was us coming together, and basically I was part of the fundraising group as well. So we went around for all the tech startups in Copenhagen and fundraised to hire someone who could kind of run the community, if we could say that. So that was a pretty cool start. And then we started doing these town hall events and things like that. It actually came out of the idea that we could see that the tech community were booming. This was like 2012, 13, I think. The tech community was really booming. We're seeing a lot of events happening. We're seeing a lot of companies starting out and starting to fight a bit over the same talent, and starting to trying to compete over creating events that would attract the right people and stuff like that. So what we actually understood pretty early on was that in a small community like ours, for those who are not familiar with Denmark, I mean, we've little over 5 million people. Copenhagen has, I would say, on a good day, it's like 1.2 million, but in fact, like close, it's like 500,000 people, right? So how can you how can you survive as an ecosystem if you're fighting amongst each other, right? It doesn't really make sense. So we kind of got together with the notion that we gotta really work together. We gotta share ideas. We gotta share our experience, our knowledge, our contacts, and even share our lead lists and stuff like that, right? So that's kind of what happened. We thought about this thing, saying when we shouldn't be in competition with each other as much as we should be in competition with the surrounding cities like Stockholm, Berlin, London, those kind of things, because we are fighting with them actually to attract talent. So we really sat down and said 2 plus 2 equals 5 or 6 if we do that. And ever since, I would say there's been a very, very good community in Copenhagen. I think that's one of those things that has sparked that, and it's something that we have continuously had. I mean, there's been ups and downs, right? Sometimes you see some fractions and things like that, but in general, we have an amazing community, and I think that's part of why Copenhagen is generally looked upon punching way beyond its size, you could say, right? Or weight in that sense. So I really, really think that there's that has a huge impact on that. We got together, we fundraised, we created this, and then at one point I was actually asked to run that as well. So I was CEO of that organization for a while as well. We did the big town hall meetings, which completely transformed the ecosystem as well. And then we made a big like community festival called Tech Festival as well. So that was it was a very interesting event, very community driven, and it really spawned a lot of energy into our system, and made internationally known that something really interesting is happening in and around Copenhagen.
Yeah, I mean, even today, when I go around cities where those cities host large conferences, you see startups competing for those side events and the audience. It does make sense. I think one event in SF where I went to, where I saw some sort of coalition, maybe like 5 companies trying to host something together and share the costs. I think that what you did there is should happen a lot more. I think it'll be a lot more efficient in terms of deploying capital for these companies who are young to do events together rather than compete with each other and do it
And
alone.
that's definitely what we tried doing
Is that
back in the
going?
day. So it's actually, I have to be honest, like COVID actually killed that event, to be honest, right? Because it had to lay dormant for a while. It was a non-profit, and that completely stopped that. And since it hasn't really started again. But what we have been able to sustain in and around Copenhagen is TechBBQ, which is a separate event
Right.
from. I mean, Tech Festival was a distributed festival all over. One of the largest area of Copenhagen, 130 distributed events, lots of people involved, very community like on conference setup.
Mm-hmm.
Whereas TechBBQ is much more like an actual like tech startup conference, very professional, super nice setup. It's a bit more if you compare it to Slush. I'm sure several of your listeners are familiar with that setup as well. It's about this. It's
Yeah.
about 2/3 of the size, which is still significant. I think this year TechBBQ is going to reach around 10,000 people. It's
Mm-hmm.
also a lot of the same companies, a lot of the same funds and stuff like that. That comes. The vibe is very
Mm-hmm.
different. I mean, Helsinki is very. It's in December. Often in Helsinki, it's very dark. It's cold outside. So you come together in. And also the venue is very dark as well, very professionally set up, lots of lights and stuff like that. So it creates this like intimate atmosphere, super nice. Also for someone who, I mean, I care a lot about it, graphic design and stuff like that. I think it's so, yeah, it's very elegant. It's very visually pleasing what they're doing. I really like that. But also it creates this kind of intimate atmosphere. Whereas TechBBQ is, it's in August this year. It's going to be very much, summer vibe, much more bright and serendipitous actually, because of all this light and um, a lot of open side events as well. I think Slush is also a little bit about being in the know, getting access to the right side events. They're a little bit hidden. Some of them might be official, but most of them are actually hidden, stuff like that. I think TechBBQ is a little bit more
Mm-hmm.
about inviting everybody in, even more about serendipity. And so I think it's two very different events with a lot of the same
Yep.
people. And I think they're both an amazing event to attend. If I gotta be honest, I know I work I
Yeah.
work with one of them, but at the same time, I feel like I can be objective. I've done it for 3 times now, but I've participated in all 11 versions, right? So I think it's been a bit to Slush many times as well, for sure.
Yeah. Yeah, I've been to Slush as well multiple times, and I think I've enjoyed it. Unfortunately, I've never made it to Tech Barbecue, but
This
now I
year,
have a strong
yeah.
reason. How much of like obviously it's a smaller event, similar audience, so startups and investors probably. Any specific category of startups for which the event is suited more versus less?
Yeah, I would say TechBBQ is definitely. I think young startups. I think it's a little bit. There's a little bit higher concentration of that. I think we are known for as a conference where it's easy to meet like the younger startups and connect with them, getting to know the whole. You could say. Pipeline into so deal flow basically, right, for investors are super important at this event as well. I think we're
Mhm.
seeing though a huge shift, so we are also seeing what everybody else is seeing, that a lot of the later stage funds are looking earlier as well in the market. So we're definitely
Mhm.
seeing that across Europe, also in the Nordics. So we in the last couple of years we've seen even more later stage funds coming in, and even also private equity also looking in, right? So I think that's definitely happening. But that's also because we've been able to attract a lot of the investors that are, prominent in the market. We also have a very cool like LP gathering and things like that. So I think those are some of the things that will just lift the whole thing. Also on the program side, even more professional. We've also been very strict on program as well, making sure that it's really a program where you're not buying your way on stage. I mean, we are a nonprofit, right?
Mm.
We want to do what's best for startups. We want to make sure that this is about the life surrounding building a company, but not just the
Yeah.
technicality or like the whole, you could say, life cycle of a startup, right? But also the ideas behind it. How do we build something that really matters? out there, right? So that's something that we emphasize a lot.
You've been involved with TechBBQ for you said 3 years now. What were some of the hardest challenges in building a community like this, also non-profit?
Yeah, it's a good question.
Slush is run by students, but this is obviously not run by students, run by professionals, but non-profit. What were some of the big challenges
Yes,
building a community?
I mean, yeah, it's a really good question. I think without going too much into details, and I think the basis of starting those two events have been very different. I think Slush was driven out of the actually again back to the launch of the iPhone and subsequent Nokia failure, you could say, in Finland, and they decided to very quickly change the pace, and it was also around the financial crisis, right, 2008, and then they very quickly came in and said, let's support building a new culture of entrepreneurship in the country, and amongst that, let's start Slush, and then let's bring in the universities as well. Make sure that the students who participate can get EasyJS points and stuff like that. Make sure that we build this like an actual ecosystem within this, right? So that was very much like a government initiative, you could say, or at least very strongly government supported, at least, right, from the very beginning, and city supported as well, also financially in the beginning, and that has been able to create this rather quickly in the market. I think TechBBQ was started again. It's just a different setup we have here. So we didn't have this crisis in Denmark when TechBBQ started in 2013, I think it was. It was a bunch of people again from the ecosystem coming together and say, part of this whole thing that we're doing is we want to create this big tech event as well. We see that the Slush is happening. We could do something similar in Copenhagen. Let's do it. And it started out by just being 300 people. And then it's very community driven locally as well. Very few funds involved, so it's more like whatever we could scrape together and build and work. And it was a very small organization for a long time, very volunteer based, things like that. So it's just a totally different way of starting, right? And then having built that throughout the years, I think it's a huge kudos to actually the management who are still here as well. Part of many of them have still been part of it from at least from like 2016 or so, right? When there was 1,000 people, so now it's 10,000 people. It's been many fold bigger organization and stuff like that. So I think that's another way of building this kind of machinery, right? And that takes a lot as well. So a lot of blood, sweat, and tears and dedication. Without the same kind of government and city support. It's coming now, of course, but when it's already like a success, and that's amazing, and that's some of those pieces that are missing to make it to even to the next level, right? So that's really good. But I think what's important, we sometimes talk about this. What is the role of these mega events? I think that's super important. It's one of those things where you have a lighthouse event that once a year brings everybody to your city, to your community, and it's a platform where when you reach that scale, then all of a sudden the government thinks it's interesting. All of a sudden, ministers are showing up, to this, and that's important for you to actually be able to change things, right? All of a sudden, the CEOs of the big companies attend, right? All of a sudden, your pension funds thinks it's interesting to come and join and maybe be able to do this, right? So if you don't have this mega event, a lot of times these things won't happen because there might be a lot of activities happening. It might be an exceptional place for fostering growth, right? But you need these things to attract and make big changes happen. So you need this place where top people fly in to attend, and that's super important because a good thriving ecosystem requires all the participants actually to come together to benefit for the whole for the rest of the year. All the other this is a 2-day event, right? 3 days if you count the investor days. So that means that the rest of the 362 days you really have to get to work, right? So of course a mega event is not what makes a great community. It is not what ensures that entrepreneurship can really thrive in a country. That is what happens every day. That is having great events happening, people just taking initiative. It is having good like incubators. It is having good investors as well, a thriving business angel community, having access to you could say what's called like an active IPO community, all that stuff, right? That is what is needed on an everyday basis. But these mega events, they can help putting that you could say, spotlight on the industry and help with bringing in the big guns, that could eventually lead to real change as well. So I think that is why those big events are so important as drivers in this sense, for sure.
Also, bringing people from outside, they notice new
Yeah,
opportunities that are local, and similarly, local people seeing opportunities outside.
100%.
Maybe they make connections where they can
And we
expand.
always,
Yeah.
as I always say, it's about preparation, right? And I tell that to every founder I know, make sure that you free your calendar in those days, because you can go to London, of course, you can go out, you can meet five investors a day, right? But it's very expensive.
Yep.
You have to book
Yep.
all these meetings, travel all the way around across London, and you only meet 10 people in 2 days, right?
Yep.
These couple of days, everybody comes to you, right? That's the thing. So the local entrepreneur.
Yep.
So make sure you book as many meetings as you can, attend all these events, the serendipity as well. I mean, you can meet so many people in just a few days, and it doesn't cost you anything because you're right here. So for the local community entrepreneurs, I think it's super important, and it can accelerate a lot of stuff. So
Thanks for pointing out the light. I didn't realize
no
that.
worries.
Um, Yeah, so I was saying, you've been running the investor relationships for TechBBQ. A lot of founders are, of course, very interested in building relationships with investors. Fundraising is obviously almost a full-time job when you do start
Yeah.
fundraising as a founder. What are some of the parallels or lessons from your journey talking to so many investors that entrepreneurs can kind of use?
Yes, 100%. I also fundraised myself, right, and raised
Yeah.
money
Yep.
some years ago, and I learned a lot from that as well, and also
Mm-hmm.
from seeing from the outside. I think a lot of
Mm-hmm.
at least first time when you start fundraising, you do
Mm-hmm.
a lot of mistakes, right? You don't do enough research. You don't know exactly what is actually really working. You just read this and then you try and do this. But I think there's a few things that a lot of people won't tell you about. That's kind of the underlying things, and a lot of it has to do with something that's completely out of your control as well. I think, of course, it is important that you know your market, you understand, you have a great team. Of course, I mean, team is really crucial, right? I think that's number one tip, but that's any site will tell you that, right? So team is the most important
Yep.
thing. Find the right people, and but it is true. It really is true. It's all about the people. You invest
Yep.
in people also as an investor. But actually,
Yep.
of course, it's about the CV that you have and what you've done. But it's as much, do I trust these people? And so I think trust is something that a lot of people don't talk that much about. It is this element where, as an investor, what kind of what signal does the founder that you're talking to send you, right? And it's not just in the
Mm.
first meeting. Of course, that's important, right? How do they connect? How do they verbalize the problem that they're solving? How do they act? How do they engage? How well do they explain what they're doing? Stuff like that. That is, of course, important. But it's also important after,
Mm-hmm.
right? So when do you hear from them again? Do they send you what they said they will send you? Do they continuously get back to you? With the just like friendly updates, stuff like that. Because it's like a mini cosmos of what they're going to do to other people, right? So if they're not very good
Mm.
at getting back to me, or if they're not very good at following up, if they're not very good at basically selling themselves to me, they're probably not going to be good at that other places, right? So it's a little bit about that as well, the trust you create.
Mm.
Are they able to create some sort of relationship with you? I know but those are some of the things that you should definitely remember as a founder, to kind of be very
Mm.
methodical in your approach and do that. And then, of course, you should really research as well. You really should research who it is that you're going to meet, because if you just spray and pray, you waste too much time, and the investors are just going to be a bit, it's not really tailored to me, this thing. So there's a number
Mm.
of things that you can investigate. For instance, of course, the basics. Do they invest in my geography? Do they invest in the stage? So the ticket size that I'm raising, the amount of money that I'm raising, does that fit with what they invest in? Um,
Yep.
and also, of course, do they invest in my industry? Are they relevant for that? That's kind of like the very basics. Okay. Then there is a
Yep.
number of
Yep.
other things that you can investigate. So have they just invested in another company that is just like mine or within this space? Then they most likely won't invest in this. They'll probably take the meeting because they want to hear about the competition for the company they just invested in. but they won't invest in
Yeah.
you, right? So you should definitely know that.
But sometimes they do, right? Like for example, few investors want to own the market or the segment, and they do invest in multiple startups in the same segment, like SoftBank and the bigger
Yeah,
players.
but that's typically a bit later, right? That's a later stage play.
Yep.
So yeah,
Yep.
but what I'm typically talking about is if you're starting out, right, and it's kind of a bit early stage, if that makes sense. But
Got it.
I agree.
Got
I
it.
mean, if you can get SoftBank as, but they are seldomly the first money in, right? It's more like a bit later
Yeah.
stage.
Yeah.
I agree with you on that.
Yep.
So if you already feel like you're backing the category winner, then it would be nice to kind of, add maybe surrounding companies to that, or within like a value chain within an industry. So I agree with you on that.
Yep.
But to my experience, direct competitors, very, very seldomly, they will
Yeah.
invest in
Very,
two
very.
competitors. Because that would be like,
Yeah.
that's like they seldomly hedge their money
Conflict
like
of
that,
interest.
right? It's not like, they do tend to see a lot of these investments as a zero sum game, right? So one has to prevail,
Yep.
and then they believe they have backed the winner of this. So that's typically,
Yep.
at least. There's other things, and this is something that people need to understand about funds, right? They have their own cycles as well. So this now we start to get into some of those things that is outside of your control, but that you can still kind of investigate a little bit. Sometimes, like if you understand how investors and particularly VC funds think, then there's a number
Hmm.
of things you can say. Okay, so typically a VC will it's not they're not investing their own money, right? So they're investing from a fund, and that fund they have
Yep.
raised from other investors, you would say bigger investors, called in this particular case we call them LPs, right? So limited partners. They invest into the fund, and
Yep.
then the VCs will invest that money, and they typically
Yep.
have to return the money in 10 years with a profit. But that means that
Hmm.
if you're returning it in 10 years, that means that a number of things have to happen those 10 years. Of course, they need
Yep.
to deploy all the money and invest the money into startups that will grow in value, and then 10 years later they will be worth a lot more, so they can sell their shares in the company and return the money with a profit, right? But
Yep.
what is actually interesting as well is that in order for that to happen, because it's a high risk investment, it happens typically early on, so it needs time. The company needs time to add value. That means that they will
Yep.
invest pretty much all the money in the very first years of this. So in the first,
Hmm.
pretty much the first 2 years of raising a fund, maybe even before they kind of close the fund as well, they will deploy all the money into new companies. And let's say that they have a goal of, oh, we want to invest, I'm just saying a number here, invest into 30 new companies. Within that, that means that they will invest in roughly 15 companies every year. Or we can say 25, then it's roughly like three every quarter they will be investing in
Hmm.
over
Hmm.
that time span. And then then they have some money set aside for the next 4 or 5 years for follow-up investments. And then after that, they pretty much just wait and see the money, like being or see the companies grow in value. And that means that those first 2 years, right after they raise a fund, or if they are like later stage in the fundraising process, you can typically read about that in news. They will typically tell you where they are in that fund.
Yep.
That
Yep.
means that in the beginning, there's a higher likelihood that they will actually invest. If they're closing a fund, so they're like at the end of the 2 years and 3, 4, and they haven't raised a new fund, they will meet with you, of course, but they typically don't have any new money that they can actually invest. So they will kind of,
Yep.
but they will typically meet you just to be able to say to the LPs that they're fundraising from, we know all these cool startups that we want to invest in, but we don't have any money yet.
Hmm.
So that is one thing, right? Um,
Yep.
so it's about understanding where are they in this cycle, because you want to make sure that if they're at the end of the cycle, then it could be very good to meet the investor, but just be focused that you can build the relationship with the investor for the long term. That they probably won't invest in you right away. I think
Yep.
that's in general a really good rule. Don't assume that you know that they will invest now. And then of course, then even more, if you look at it, they also have these quarterly cycles, and they also have monthly cycles and stuff like that. They have
Hmm.
they have partner meetings internally where they make decisions and stuff. So very often the thing is, if right after they've had this quarterly thing, then they might not decide for another 3 months who to invest in. So you should also know, I mean, especially in the beginning of that quarter, whenever that is, then they will be more likely to go out and have meetings and stuff like that. And then they will later on make decisions. So it also means, I mean, just on the very short term, when you're talking to an investor, have they just decided, have they just, allocated the money for that, for the next, for this quarter and even the next quarter? If they just invested in 4 companies, it might be a while before they invest in more companies. So you should be more patient with that investor. It doesn't mean that you shouldn't talk to them. You should just be aware of those things and kind of have that in the back of your mind, so you don't become desperate or you don't become angry or stuff like that. So there's a lot of factors that you don't actually know. And then of course they are lemmings like everybody else. So the better angels you have, the better names you have there, they might know them. Then you might be able to get a better VC and better and better brand names and stuff, because it is also about the brand name of the investor you get on board. But that actually trickles down. I mean, if you find the right, I mean, you're an angel investor yourself, right? And I mean, if you invest in a company, there's 2 things, right? You invest the money, and hopefully the company will spend that money to build more value, right? So they should use if you invest $50,000, right? They should be able to create value that is more than that out of that, right? And that's one thing. But secondly, you also need, because at some point you're going to want your money back with a return. And the best way of doing that is to help them find the next investor who are willing to see that there's been built a lot of value into this. So we want to buy in at a higher valuation than what you bought into, right? So that's the nature of this game. And so it's very good to find an investor that can help you find the next investor as well, so to speak.
And the caveat to that is, you as a portfolio company, you have to be doing well and showing them that they can put their neck out and make those introductions. If you're tanking as a company, they're not gonna.
Then we come back to the trust, right? The trust is super important, not just before getting the money, but also when you're actually working together with them as investors. And it's super, super important. I mean, you know this as well. If you're talking to a company about potentially investing, and they have already got some investing from an investor, and if that investor is no longer interested in backing them for the next round, that's a really bad sign. So there's a lot of things. I mean, relationship building is super important. Being trustworthy is super important. That I think that's one of those things that a lot of startup founders don't think about too much. And investors talk a lot, right? So that's the thing. I mean, I was surprised when I started building this part of TechBBQ and working with investors, right? I was actually surprised at how much they share their portfolios, because when people come to TechBBQ, the local funds, the Danish funds, they will not talk to any startups during those days. They will only talk to later stage investors than what level they are at, because they need to kind of find the next investor for their portfolio companies. Of course they will, but they will use those portfolio companies and pitch them to the other investors. So the international investors coming, they meet the local investors to understand what are the startups here, who should I meet, and they use the local investors for that. So it's actually a very important thing for them to do that. And that means that if you're in good, and that doesn't only apply to your own startups that you have invested in as a local investor. You could also say, oh yeah, I've heard of these guys, you should probably meet them, because then you indirectly tell that foreign investor that you know your ecosystem very well. I know the cool startups, I know the ones you should actually talk to, right? And that's important as well. So any investor you talk to, make sure that you don't take them for granted. You have to think about their extended network. And if you deliver a good impression with them, even though they might not invest, they might pitch you to somebody else. So you should know that as well. You should really think about that. It's the collected network effect of those things.
Basically, having a good relationship helps you in the long run.
We can spend a lot of time talking about metrics and CAC and customer, lifetime value, all that stuff, right? But a lot of other people are talking about that. I think this part is what a lot of people are missing, and they don't really necessarily understand.
We met at one of the investor events that was on the side of Slush, and That was one of my first investor events, and I saw another side of investors that I was not exposed to directly as a entrepreneur and a founder, which was there were investors raising money. Do you want to talk a little bit about your experience helping investors, and shed some light on what goes on from the investors' side of view when they raise money?
Yes, this is also one of those things that a lot of, when you're from the founder side, I know, for instance, when I was fundraising, I didn't really understand that so much. You never think about where the money comes from, other than it's a VC that has the money, and of course, if it's a business angel, right, like yourself, like I am as well, then it's our private funds. But a VC fund, as I said before, VCs are fundraising from LPs, so from pension funds, from the large family offices, from, it could also be from individuals with larger larger checks and who want to diversify a bit more, because of course it's a bit more diversification to invest via a fund that invests in a lot of startups than investing just in one startup at a time. But these so that's actually, and I mentioned also before the 10 years they have to return the funds, and the first 2 years and the next 2 years and stuff like that. But this whole setup, because the way the VC makes money is two things. They make money from the management fee of the fund. So let's say they raise $100 million. The typical model is a 2% management fee every year, which means $2 million every year. And that's what they spend on their operations. Salaries for themselves and for others, and marketing and traveling and dinners and all that stuff. And they can have that, but that doesn't cover for the whole 10 years. It's only for the first couple of years, 2 to 4 years, something like that. And then they also, of course, have carry, meaning that whatever return comes after the 10 years, or whenever they give the money back, they also take a percentage of that. Typically, it's like a 20% of the profit or something like that. That's typically how it is, just very roughly. But this means that because they only have like salaries covered for the first couple of years, that means that after this, they have to fundraise a new fund as well. And part of this new fund could be follow-up investments from the first fund, but it also means that once they have raised that, then they can start investing in new funds. But then they can also pay salaries for themselves again. So the fundraising bit is very important. And like startups, who typically it takes a longer time than most first-time founders think to raise a fund. It also takes a lot longer for a VC to raise their fund, especially the first time around, than they may initially think. And I think it's important as well for a lot of VCs. I think it's interesting just seeing it from this side, how so many VCs will say that there's so many bad pitches, there's so many bad presentations, the startup founders don't know how to present, they don't know how to follow up, they don't know how to do this. And then you hear exactly the same, they make exactly the same mistake once the tables are turned. So all of a sudden, it's the VC partner that you're sitting there, this very important person that you're pitching to as a startup founder. They also have the opposite, where they become like this person who comes in and pitches and who are really nervous and wants to obtain all this funding, right? So it's kind of similar. And the funny thing is that most data will show you that, especially these times in Europe, is very, very difficult raising a fund. I'm sure it's exactly the same in India, right, and other parts of the world. But it's really difficult, and that means that they have to meet a lot of LPs actually, and then it becomes interesting because they have to understand who they are facing, and they are facing people who typically have like a financial background, it could be people from corporate finance or from one of the big investment banks or stuff like that, who have been placed at this LP, like a pension fund or a big family office or something, to make sure that those funds will grow in value. And they can invest in anything, right? They can invest in stocks, bonds, real estate, keep cash if they want that, right? Or whatever, oil, all kinds of assets, right? And then they can invest into venture funds. But that is this little thing called alternatives. They always call it alternatives because it's high risk. And the reason why it's high risk is, of course, that it is a risky business. So it's a risky business being a founder, right? You don't know where it's going to go. But the ones who put in the first money has a higher risk, but they also have they could be a higher return. There's a lower chance of return, but then the returns will be higher. So it's high risk,
Yeah.
especially if it's early. It's also high risk if it's a first time fund manager. It's like investing into a first time startup founder. If you invest into a first
Yeah.
time fund manager, a VC fund, that's also a risk. So all this becomes about risk. And again, as soon as you're dealing with risk, what's important? Trust, right? How do you kind of leverage that? So the same thing as like a VC needs to trust you as a founder, an LP needs to trust you as a fund manager, as a VC fund manager. And that is just something that VCs also need to know, and they need to understand what is important. I hear so many first time, we call them emerging fund managers, the ones who start a VC, right? Raise a fund for the first time. They talk about this thing where they are so surprised because they go to the LPs and then they think they're going to pitch right now how good they are at finding the right companies right now and who they know right now. And I'm going to invest in this company, right? And then this fund is going to return so much in 10 years. So they build kind of that. But then they get surprised that the LPs say, yeah, but that's all good. But what are you going to do about the next fund and the next fund again? So, so what's your plan for fund two? What's your plan for fund three? And then they're very unprepared for that. They only think about the first fund. But the reality for these LPs is that they are not in the 2-year game. They are in the
They're in 10 years.
generational wealth kind of game. So they are thinking very long term. When they place the money, I mean, they think that 10 years is a fine period of time. And you have to imagine that they are always benchmarking it towards other asset classes. Could be real estate, for instance, right? How much would they make in return every year over a 10-year period in real estate? How much would they make of bonds, right? So if they're placing that, even like a 2% bond, right? How does that, it's pretty cool. So how do they value this asset class compared to the risk they're taking is very interesting for them. That's what they need to see. And they need to see this over a longer period of time because they don't want to just be part of the first fund. They want to build a relationship with you so they can invest in the next fund and the next fund. So they already way ahead. They think much more long term than most VCs do.
Which probably means that it is much, much harder to raise a new fund with just like a startup
Yes.
or a founder who's raising for the first time.
Yes and no. What we're seeing now is we're actually seeing this thing because we're actually seeing right now in Europe, because that's where we're at right now. We're seeing this thing where some of the more established funds are having more trouble raising compared to what they had previously. Because it used to be about their track record, used to be about that. But now we're also seeing, because we've just seen a couple of years with declining returns. It's been really tough for the last 2-3 years here. 21 was the best year ever, but 22, 23 has not been that great. 24 not that great. That meaning that the LPs who had massive returns have started to become suspicious. They're a bit more like reluctant to just invest. Also, a lot of money has actually not been returned in time because it starts with the consumers that don't have as much money, meaning that they don't consume as much, meaning that a lot of the companies are falling in. Their value goes down, and when the value goes down, you can't really sell your company in the market. And when you can't sell it, the money is not being returned to the investors, and then the money is not being returned to the LPs. And a lot of the LPs, they actually want to recycle the money. So they're kind of waiting for those money to come in to invest in a new fund. So that's also why the whole thing has stopped a little bit, because of the lower valuations on startups and scale-ups. So it's kind of a whole financial ecosystem. So that just means that the LPs are also a little bit more like, it's all great because you've done this. This is now your 6th, 7th fund. You've proven it, but you also became very, very rich in the meantime. So you're not as hungry anymore, right? As a manager. And who's gonna follow you, right? Who's the next in line at your company, right? Who's gonna ensure that our money will keep, growing, right? And by the way, because you've been so successful, you now charge a lot more for this. So now you want maybe 3% or 4%, right? So it becomes different, right? So some LPs will now see it's actually more interesting for us with the emerging managers because they're more hungry, right? It's a bit like investing in the young stars, startup wise, instead of the incumbents, the guys who've been 20 years in an industry and coming out, and say, I can easily do that, but it's not as much of a burning platform for them anymore, right? So I think you can compare that a little bit. And then, of course, a lot of the new funds, they focus on different things. They also focus on the green transition, for instance, investing into new areas that are very interesting for LPs. It could also be just new business opportunities. I mean, defense tech is something that you could always argue whether or not that's a good thing, but it's definitely a rising opportunity. And that means that a lot of people will also look at some of the new areas. And a lot of the old funds can't really transition because they have the mandate they're used to a certain area. They don't really want to go into these things. So there's this thing about chasing new opportunities and stuff. So that's why emerging managers can also be a thing, right? So for sure. But they still have to build this relationship, and we have to understand, and especially in Europe, raising a VC fund can be very difficult. You meet, they will tell you, I have to meet like close to 100 LPs to close one, right? So about a 1% thing. It's not always like that, but it's very difficult, especially in the current market. And you will also see that a lot of the LPs will take months on due diligence and stuff like that. Whereas in the US, a lot of especially like family offices, they would have to do due diligence within 48 hours to get on the best deals. It's a totally different climate in Europe for sure. But I think it is changing. In a sense.
Well, what are some of the markets where you see in Europe that it's changing faster than other places? Is it Denmark? What markets are becoming more interesting from a startup point of view?
I think that's a really good and big question. I think it depends on what industry we're talking, right? And a lot of times industries are driven also by some of the incumbents. I think, for instance, in Denmark, we're seeing health has a really big boost, and that actually comes from one of the most valuable companies in Europe, Novo Nordisk, right? So it actually, and they also invest a lot. It's one of the most active investors in Europe. That is actually Novo Nordisk through one of their like a foundation, like a holding company, right? So these things are often triggered by those kind of things. You see the same in Sweden, right? They have a lot of different industries, and then they would typically, I mean, they've been quite big also in, for instance, fintech. So they also invest in that, right? So there's a couple of things where it's kind of driven also by the big companies, funnily enough. And then, of course, we're seeing the green transition. There's been a lot of that happening. And now, of course, with the new you can say tones from Trump and his administration, right? Who knows exactly where that's going to go? But there's been a lot of focus on that. But I would say in the Nordics specifically, health, fintech is quite big. SaaS has always been quite big. So I think those are some of the things that we excel on still. Then there are other areas like quantum computing, right? That's arising. And then, I mean, we talk a lot about AI in Europe, but as we all know, I mean, we're not exactly at the forefront of that. But of course, we're trying to do some things there. But we definitely see a shift across Europe because of the war in Ukraine. There's been a lot of focus on different things. I mentioned briefly defense tech earlier, but I think actually this whole thing about being strategic about the investments, being strategic about IP, and keeping it a bit more like domestic. We're seeing that across Europe and across the Nordics as well. And that's actually it's from a political viewpoint as well, also being driven a bit by the focus from some of the government vehicles like the sovereign funds and things like that. And it's not necessarily a bad thing at all. It's just the reality right now. We're seeing that. So it's actually and we're also seeing more investment, for instance, from a European standpoint as well into this. So this whole thing about defense is being seen in many things. It's also being seen, like developing health solutions and AI and stuff like that. So you have ownership of these things, right? So it's not only like defense technology in itself. It's also it's very broad.
Independence from outside forces, so that you can self-reliance.
Yes, basically. It's just a new world order that has started to happen, right? Not world order, but maybe like we just have a new
way of thinking, I guess.
The world is different.
I think the next 2-3 years is going to be very interesting.
So, but we can always see it from the influence that this has politically, for sure, and definitely the government investment vehicles and the EU investment vehicles as well is a part of that as well. So it's quite interesting to see what will come out of that for sure.
Yeah. Yeah. We were talking about PMF and product market fit, and why it's a bad idea to sell where there is no budget. What was your experience in launching the business? Do you want to talk about how you ended up uh, not being able to scale the product?
Yes, yes, that's true. Having been a founder, I think there's a couple of things that you learn from that. I think this was one of my biggest learnings, and I've actually been able to use it in many different ways. But I think it's something that, I mean, it sounds like a no-brainer, and then of
Hmm.
course, but when you're in it, when you're building a product, and when you're talking to potential customers, it is something that is often overlooked. Actually, it is
Mhm.
this thing that you need to make sure that what you're building is something that your actual customer will perceive as a big enough problem that they are willing to pay enough money for it. And I know
Hmm.
that sounds of course it's like that. But I can give you this example from the telco industry, right? So it's a bit back in time, but I think it will resonate with a lot of people. But I mean, today inside the EU, whenever you have a mobile phone subscription, I would say, at least from our part of Europe, um,
Hmm.
95% of them, you have this subscription where you can just use any network in Europe, and it's kind of on your
Yep.
standard subscription. You don't have to pay extra. So it's basically whenever
Yep.
you're roaming, it's kind of free of use. There is,
Not
yeah,
really
yeah,
wrong.
but it wasn't always like that, right? So if you go back like 10, 15 years, around 10 years ago, it kind of stopped. It kind of started with the current situation, but before that, it was totally different. Every time you traveled, you
Yep.
paid a lot more. It was very expensive, and it was a huge irritation for a lot of people. And then we had
Yep.
this local network called Three that owned a few operators, and then they made a deal to that they wanted to create a subscription to cover those countries, and that was really easy for those kinds. But everybody else still had that problem. And we actually we went in and found, it wasn't me because I'm not that technical, but one of my co-founders found a solution to eliminate this kind of roaming technically in the system. It was an intricate system about how you would connect to the local networks and stuff, and identity on your SIM card. So it was very intricate, very, you can say, complicated software solution, but it worked,
Mhm.
and that was the crazy part, right? So you can go from one country to another country, and then you would actually be considered local in that markets, right? Especially across, if you had like Telenor, who had a lot of mass, you could implement it on their network, and then you could have it exactly the same as the other one. Now, the difference would be that
Mhm.
in this case, because in the other case where with the competitor, they would actually be paying still. They just wouldn't front the customer in this particular case. So they would just be taking the bill, you could say, themselves. The company would, and we could actually eliminate that. So it would actually be a cost-free solution for them to do this. So the cost they would have today, they wouldn't have to have that, because the cost the
Mhm.
company had was the reason why we had to pay as customers, if that makes
Yep.
sense. Anyway, so we found a
Yep.
solution, and we wanted to test it. They were willing to let us test it and stuff like that, but there were two kind of main departments inside these telcos, just to simplify it. One was the commercial department, and one was the kind of technical department. We had to work with the technical department to be able to test this, and that was all good. And that was like the
Mhm.
wholesale department. But the commercial department, they really wanted this. So they were really driving this. They were saying, like, our customers, we would love to have this product. No roaming for our customers would be amazing. We could really sell the shit out of that, right? So they had a
Mhm.
lot of pull inside. They could convince the rest of the organization to kind of test this. And that was all well and good. But then eventually, what happened while we were testing it and we went through here, we found out that some of these companies just started to lower the price on their roaming products, essentially doing what the other company was doing and say, yeah, we know it costs a lot of money, but it's okay. We'll just build a product, like a purely financial product, and say, okay, it's free for you now to do this. And that meant that
Mhm.
commercially, they already had their product. commercial departments, the sales department, they didn't care anymore. But
Yep.
then we went to the other department and said, listen, we can actually save you a lot of money on this. There's a lot of money that can be saved from this. But it turned out that nobody was really interested in that because the money was already being budgeted for. They could pay however they wanted for this roaming thing. What they were interested in was just making sure that the telco and the coverage would always be at 100%. So there could be no downtime. That was it. And our solution would impose some sort of risk into the system. It was not very high, but there was some sort of risk. So they'd just rather not do it. So even if they could just pay us a very little amount of money to have this running, and they could save millions on this, many, hundreds of millions, they wouldn't actually do it. There was nobody who had this as a KPI to save money on this. There was nobody who owned that. The only KPIs were on making sure that they was fully functional and there was no outtime. That was it. And we actually struggled there quite a bit. In the end, we just had to kind of, so we actually diverted the company a little bit, and then we did something else. But eventually, we kind of had to close down that part of the business, right? Because it wouldn't come to anything, which was quite interesting. So it just learned us a lot. This thing about making sure that whoever is your actual customers, the one who has the budget, the one who's a budget owner and who has money to spend, sees this as a real problem that they need to solve. Yeah.
It also sounds like two problems, right? One, you were in the cost saving game and not the making money game.
Yes.
Which is it was not really new business. It was from the existing business saving money.
It was actually both. I think you're totally right. So I think making the switch from one department to another certainly didn't help. But I think even from the beginning, they were just more interested in the technology. So even when we made the test and stuff, it was quite clear that they didn't have the budget to kind of continue with us afterwards, right? But they were just interested in the technology, I think, and they liked us. So we might as well, but for me, it also just comes down to the fact that make sure that if you're doing B2B sales, just make sure that whoever you're talking to inside the company, that they actually have a budget, and they have a budget to solve a problem that you're solving. So, I think it comes down to that actually. And remember, we are all people, even inside a big corporation, right? When you're trying to make a deal with Google or Amazon or any other large company, it's all about the people. And whoever you're dealing with, whoever you're trying to sell to, they have a KPI. They need to do this. And if you can say, oh, I can solve 70% of your KPI, then I can tell you they definitely have money for you. So it's a lot about making sure of that.
Yeah, understanding what is important for them, what's going to move them forward, I guess.
100%.
Makes sense. All right, given we are almost out of time, there is a couple of rapid fire questions, and it's time for the rapid fire. So one underrated piece of advice for an early stage founder.
Underrated. I think it is really start super early talking to clients, start super early talking to investors as well. It is about building relationships. And I think a lot of people think it's about building the right product and knowing your market and stuff like that. But you will find that along the way, you need good relationships with your customers and your investors.
One unconventional hack for getting investor meetings, given you've got so many meetings yourself.
Unconventional hack, I don't know. I think a bit unconventional might be to become an investor yourself. I think that could actually really work. So if you do that, that means that you will have a different type of access. For me now as well, I just become an LP as well, and that just gives me even more access. So I think it could, it might be an expensive thing, but as soon as you are that, then you can say, okay, I actually am now just like a part of this crowd. So you can get that investor ticket for the event, or you could be invited for those things. And that means that you're more on the same level, but then, I also have this thing, if that makes sense.
Yeah, good call. The worst mistake you've made while getting investors on board?
Yeah, so I think for me, I made an obvious mistake that still haunts me a bit, like just back of my mind. It's not like I've actually paid for it in any way, but I made the mistake of I pitched my company to, and it was very early days, and he seemed so interested, and we talked about it for hours, and he gave me so good advice. And then I went on to the next meeting, and then I actually mentioned that this guy, I was too eager and mentioned that this guy was super interested. And I probably shouldn't have done that, because the second after the meeting, this other guy, he called the other guy and said, "Oh, I hear you're about to invest in this company." And he said, "No, I just met the guy." And that was a big learning. So don't oversell these things. I really think
it's a very close community.
yeah.
It's a very
And
small.
you need to be, and I think I definitely oversold it. I got too eager. I mean, the intentions were actually good, but at the same time, it was too much. And it cost me a relationship, I guess, right? Credibility lost a bit there, right? So yeah, but I definitely learned, and I also learned that they do talk a lot to each other, right? And if you understand that, you can also use it positively, for sure.
That is true. One indispensable piece of advice for relationship building, given you've been at it for a really long time.
What I typically say is make sure that you start out by giving. It's never good to start a relationship by asking for something, or I mean, you can. It's not that, but if you're only about what you can benefit, I think that's a bit. I always start out by asking, how can I help you, right? And don't think about what you're getting back. Make sure that you give first, and then whatever comes around comes around.
Cool. Well, that's it for rapid fire. Do you wanna? How can people reach you? What's the best place to reach you?
I think I don't know if you put but you can put down my email. That's great, or my LinkedIn profile. I think that's the best.
LinkedIn is probably safer.
That's fine. Yeah, that's awesome.
All right. It was a pleasure talking and great having you.
Likewise, it was really good. I enjoyed it a lot.
If you found this valuable, you can subscribe to the show on Apple Podcasts, Spotify, or whatever your favorite podcast app is. See you in the next episode.